that is an indeed tough act to follow with a bit of kind of spicy questions up there. But so I'm founder of ETHGas. We're in the Blockspace and preconfirmation space, and just so I've been going to a few. I've been in a bit of an echo chamber or filter bubble perhaps the last couple of weeks. But is anyone here not familiar with what a preconfirmation is or how it works, at least in principle? No? Okay, all right. Well, a preconfirmation, it's basically that we have a set of validators on one side and a set of traders on the other. And what the validator can do is basically sell block space in advance. And so the trader can go to the validator and say, hey, I want to buy 1 million of your block space. Like, what is the price? And the validator can then sell that to the trader, and that's one type. So that's an inclusion preconfirmation where someone buys a certain amount of block space. It means that they're within the block. It doesn't necessarily mean they're at the top of the block or the bottom. It's just somewhere in the block. And there's different types of these things, but that's one of the types of commitments or products that's within this kind of supply chain or gas supply chain pipeline. So kind of the basic building block. Now, I've been to a few kind of events around preconfirmations and gas products, and I kind of wanted to, I guess, distill where this all leads, I think, to a number of us players. And so, instead of us kind of like head in the weeds, really focusing on the specifics of like API interfaces or unifying endpoints or something like that, like why are we doing this and like where does it go? So I put this together last night. It's a little bit messy. Please be a little bit forgiving, but I'll see what I can do. So the one of the words that will come up is basically like certainty. I come from TradFi. I spent 12 years there in an earlier life. Spent a lot of time in financial engineering and pricing a lot of exotic instruments back when models were just kind of coming to the fore. So we had the pleasure and displeasure of learning how these models work, calibrating them to market, and figuring out what makes sense to best reflect the economics of the product or industry that we're in. And so it starts with a, how can I see the screen easiestly? So it starts with a commitment. And as I said, in this case, the validator is selling a certain portion of the block, says I can get this to you really fast. And so one of the beauties, one of the upsides to these preconfirmations is that they can be offered very quickly. So Ethereum with a 12-second block time, I can basically offer a commitment to be in that block in 10 milliseconds or 20 milliseconds. And so you effectively have this super fast UX on Ethereum where I can get in like instantaneously. And so it'll feel instant from institutional users or anyone at the wallet level. And so yeah. But one of the questions that come up is, what is the price? And this has been a recurring theme within the preconfirmation and kind of sequencing group for a number of months. And one of the issues is that if you go to a validator and say like, hey, what's the price for this preconfirmation? Like these are infrastructure guys. They're not traders. The trader guys might know, but they might take advantage of the validators. So how do you create like a fair marketplace around this? Now, there's different approaches, and one of these, actually, this person happens to be in this room. So a couple different approaches. Connor, who's sitting over in the corner over here, has done some fantastic research on pricing preconfirmations. And so if you have questions on it, you can chat with him. He's really dived deep, and he gave a talk earlier today, I think, maybe, or yeah. So you can speak to him. A couple different approaches. The way I think of it is kind of like a call option on Blockspace. In the sense that I only need a preconfirmation when I think I won't get included in that block. Otherwise, I would have certainty. And so in that context, what is the likelihood that there's 30 million gas in a block. What's the likelihood that the utilization or the need for gas goes beyond 30 million? And it kind of feels like a call option, right? So, what would the price of a call option be? We can use kind of basic Black-Scholes to look at various inputs. Like I have some expectation around like a mean or a stock price. What is the distance here? What's the time to expiry? What's the volatility? It kind of just builds a framework for pricing these instruments. And of course, the utilization or the underlying instrument, it's not like log normally distributed. It has a fair amount of kurtosis and skew. From another perspective, we could create a marketplace, and the price is the price. So there's, of course, different approaches here. But in my case, we're not just trading inclusion preconfirmations, we're trading the entire block itself. And so in this case, a validator says, I have an entire block, including the sequencing rights. Do you want this? And similarly, the trader says, well, yes, like absolutely. What's the price? And so in the context of this, well, how do we price a block of gas? And there are fortunately people who know how to do this really well. And it's basically the block builders. And so on the one hand, tons of research, on like what is the amount of MEV that I can capture within the block. But within this, I call it a spot auction, basically like the next market itself. Really, the big block builders know, and they have this information asymmetry. They have this private order flow, and so they're experts in pricing the value of that block. Similarly, if we have a marketplace again, the price could just be the price, and so that's that. Now, what happens is that when we move from a single block to multiple blocks, it really changes the dynamics of the industry, of this Blockspace industry. And so, on the one hand, you have people with like order flow, right? And so, again, the big block builders or searchers or traders, they know exactly like what are the SexDex opportunities, what are the different arbitrage or MEV opportunities. But as you move further out along this curve, you basically get to an arena where this is about 12, 13 minutes ahead. And the presence of like order flow or SexDex arb, it's kind of meaningless as you move further along this curve. And really at this point here, it's more of a volatility play, right? And so in this context, the information that you have here is kind of useless. Maybe what is the general level of order flow might be an input into it. But down the far end of the curve, the value of this block space is going to go up and down with the volatility in within the on-chain and market, within the on-chain market vis-a-vis kind of the off-chain world. And so, so the question follows: how do you then price multiple blocks or multiple inclusion preconfs? And so, Finn, I don't know if he's here, but he was, I think, floating around earlier from Nethermind again. He's done some interesting work as well, looking at the pricing of, basically looking at base fee derivatives. And so with the base fee approach, he, again, you can talk to him, but broadly, it's the same variables. You're looking at volatility. You have some expectations of movement. However, unlike a Black-Scholes model, there's like mean reversion, right? So you expect this asset price to kind of come back to a mean. He accounts for jumps through this Poisson process. So it's quite a robust approach to modeling the base fee. And of course, you can work backward from the base fee to a kind of utilization on a per block basis. Separate to this, on the block native team, I was catching up with, where is he? Matt, somewhere around here, maybe. On the block native team, they came up with this research, basically highlighting the effects of like some of the solo stakers or people who haven't opted in to MEV boost. And what you'll see is that the gas utilization within a block will be somewhat consistent, and then you have like a solo staker who just builds the block themselves, and then all of a sudden the amount of gas drops, and then the next block, it kind of overcompensates. And so this is a fairly well-known dynamic. And so if we can kind of introduce that into this, then we start to have a very strong framework, or a much stronger framework from a first principles perspective on how to price multiple blocks. From a model perspective, if this is multiple blocks of time, and this is kind of the utilization of gas within a block, the gas might go up and down. And this looks kind of like interest rates. And so in the TradFi world, there's a bunch of well-known models to model interest rates. For example, like the Hull-White model or Holy, or there's a whole bunch of random models. But of course, we need to account for some of the random jumps, as I mentioned as well, right? So the solo stakers and the home stakers. So the purpose of, I guess, why I'm going through this is that, actually, I guess I'll come to it, is that we've all kind of been doing research, perhaps a little bit in isolation. I think there's a bit of a shelling point where a lot of it can start to come together. Separately, so this is one approach, right? Taking a Hull-White model, have some mean reversion in there. Another is simply that if I'm buying blocks of Ethereum, this is simply a call-up. This is simply like a straddle on Ethereum in a simple case. So if we ignore all the MEV on Ethereum, ostensibly I could buy a number of blocks of Ethereum, and I could just wait for the price on Binance to go up or down. And if the price on Binance goes up or down, I could, let's say it goes up on Binance, I would sell on Binance, and I'd basically buy across all the DEXs on Ethereum. And in that case, that's like a great kind of SexDex arbitrage trade. But so that's kind of done on like a rolling basis. But when you want to think about this from a present value perspective, you can look at the options markets, right? So I can go to Deribit, and I can see that on Deribit, like what's the implied vol for, a variety of tokens. Like maybe ETH vol is like 75%, and what are the other tokens that trade on Ethereum? What is their vol? If I short a very short-dated straddle on it, how much premium can I get from that? And I can use that collectively to then buy basically like a straddle on Ethereum itself. So I wrote this article. It basically forms a value, a boundary value condition to pricing blocks on Ethereum. It has nothing to do with MEV. Oh. Yeah, it has nothing to do with MEV, but it just forms a baseline price. And so the conclusion there was that if ETH vol is around 75%, we're looking at a block price somewhere in the 4.5 to 5.5 gwei, depending on how many blocks you could sequence together. But ultimately, if we just have a market, then the price is the price. And so this was the reason we designed our initiative as such, because there's a lot of, again, questions around how you price these instruments. There's various kind of bottoms-up approaches, like model-driven approaches. But ultimately, like if we can just build a market, then we can just get that information. And it's transparent for everyone, right? And so that, again, that drives our decision process. But what if we went even further into the future, right? Within the look-ahead window on Ethereum, we know the next kind of 12, 13 minutes of validators. But if we go much, much further, into the months or years, then there are a bunch of players who they always need to do transactions on chain, right? So what if they wanted to buy long-term fixed-rate contracts on gas? So going to a set of validators and just saying, I want to buy gas for like the next year, just give me a fixed price. Right. Similarly, on the validator side, they might just want certainty of that yield, right? So on the validator side, how could I create potentially like a fixed rate income stream, or potentially a fixed rate product? And so what I wanted to basically talk about today was that all of these things kind of come into play here. It's a mix of models, research, and market, and just kind of want to bring everyone together on this front. I've set up a Telegram group with a couple guys. If anyone's interested to just chat about these types of things conceptually, please reach out. All right. And I guess, so why are we doing this? And why do I think this is important? If you go to the kind of the physical world, there's commodity markets, of course. And so Blockspace is a crypto native commodity. And so within the commodities markets, of course, you have contango, where the futures curves are upward sloping, or you have backwardation, where the curves are downward sloping. And there's various reasons why the shapes of these curves might exist, but of course, they're all anchored to the spot markets, right? So you need some physical delivery at some point. And the players across the parts of the curve are different, right? So similar to the block space markets, you might have people looking for physical delivery of block space or physical commodities. But then further out, you just have a different mix of players, people hedging their exposure to these assets for whatever reason. And so just kind of want to draw these parallels. So one is the commodity markets, but another is the interest rate markets. And so this, of course, is a yield curve, where the yield curve is there to basically just provide certainty. Well, actually, coming back here, that's the purpose of this curve. It provides certainty to every player that has anything to do with the commodities markets. And similarly, in the interest rate world, fixed rates provide that certainty for every player for the next 10, 30 years in these markets. And you get different players at different parts of the curve. But the point is that with that certainty, everyone in the entire ecosystem can deploy more capital, can take on more risk, because within an environment where it's just a spot instrument, you can't really think beyond the next few minutes. And so, kind of messing up my delivery here, but nonetheless, Fed funds rates, basically your spot market, or basically drives a lot of, the Fed funds rate and expectations around those rates, and some other concepts basically drive the shape of this curve here as well. And again, this is TradFi, but why is this important? And it comes back to the gas markets. I'm here, and I think some of us are here because we eventually want to see Ethereum thrive as a real economy. And so if we have basically floating rate markets here, we're looking to create kind of like fixed rate markets as we move further out here. And the further we can kind of get beyond kind of the look-ahead window into longer-term gas contracts, then we get to start to create some really, really cool stuff. What it turns into is basically that we can have fixed-rate staking. And I think this should be a goal somewhere within what we're all kind of shooting for. And the reason is that because fixed rates are, actually I think I get into this on the next slide, but within the financial markets, you have the world of like equities, right? But then you have this world of fixed income, which is far larger, far institutional, but we don't really interact with it day to day. And in crypto, basically only 2 of these products have kind of found product market fit. We have kind of the definition of money. We have spot markets. We have futures and swaps to some degree, but we don't have fixed rate. We don't have interest rates. And I say to some degree because you can't kind of truly have futures and swaps without a fixed rate, so you can kind of do interest rate parity in between kind of the spot interest rates and futures. So interest rates is really like a key unlocker for like the rest of the financial products within the financial system, and that's why I'm so driven to fix this and address this. But I think we can get there with Ethereum, with gas markets, and so I think it starts with these Blockspace commitments. As much as Bitcoin is a reserve asset, Ethereum as well. I think there's an incredible opportunity for Ethereum to be on the table as an instrument for quasi-sovereigns and governments to hedge from a fixed income perspective, from a yield-bearing perspective, and of course, fixed income is a much larger pool of capital than the equities or kind of this part of the equation. And so that's it. Starts with a commitment. Just want to kind of share this train of thought, this line of reasoning, open for discussion, but there you go. Thank you. And I'll take any quick thoughts or questions. Again, just put this together last night, trying to digest everything that happened over the last couple of weeks.
Do you see any kind of potential for, I guess, negative second-order effects from, say someone can buy up the next 30 minutes of Blockspace if they think that there's about to be a huge vol event, and then you effectively can freeze out all normal DEX traders? How do you see that kind of playing out? Is that going to be possible to predict and profitable enough to buy all that block space? And what do you think about the potential for that happening, where it essentially freezes out all normal DEX traders in that big vol event?
Yeah, that'd be pretty bad. I definitely wouldn't want that.
Yeah.
I mean, to some degree, you can kind of do that in the spot market. Just pay a lot of money, right? But to the extent that you could do that in the forward or futures market, it provides that certainty to the trader, and that's something we wouldn't want to allow. But it's a space of exploration that we need to kind of push the industry in to see kind of what happens in limited steps. So we're curious but cautious as well as we go into this territory.
Yeah, but doesn't this kind of pre-confirmation stuff effectively allow for that?
It enables it, but the validators, it's up to them, right? I guess am I like a huge validator like Lido, for example? They're 30% market share. Do they want to do this? That's up to them. Or like Coinbase or some of these big guys, right? Like some of them say, we're not going to sell consecutive blocks, but maybe like just a single block, or maybe not at all. But we're just providing the choice for them to do that.
Yeah, or maybe 30% of the block or something like that.
Something
right?
like that, yeah. It's entirely there. We just provide like a suite of products, and but it's ultimately up to the validators and for them to decide.
Any other questions?
Hey, so for pre-confirmations, you typically get like a commitment for a specific transaction, right? Say to be included in a block. So now I kind of miss now, how this market should work, right? Because there's no point really in reselling this pre-confirmation, right? Because it's already done, right? Once you get this pre-confirmation.
Sure. So in our case, we've decoupled the contract from the transaction itself. So I've bought a certain amount of block space, but I don't necessarily need to include that transaction in it. So again, we've kind of decoupled these two instruments. If you as an individual don't have a need to use that pre-conf, then I guess it comes down to the individual. We think there's a number of players who would just buy block space to just sit on it and maybe resell it. And that's for them to do. Maybe market makers would do this. That's kind of their natural business. but for your the person with their own order flow, they're likely to buy it and put their own trades into it. Yeah. I guess part of this was to open up the market to other players who conventionally wouldn't participate in this market.
Thanks.
Can you not measure block space in like kilobytes, and the value would be measured in kilobytes?
Maybe.
Because like every block has a limit in space, like kilobytes, right?
Sure. Well, I guess do we want to decompose gas into its kind of constituent parts, be it like storage or compute or memory or whatever it might be?
What's like the fundamental resource at play?
Yeah, potentially. But I think it's just more that gas is like the instrument that people are using and interacting with right now. Arguably, if you could decompose it into these instruments, then that would be an instrument for the validators themselves to use and hedge on their bandwidth and infra costs. But yeah. Right.
Thank you. So when you just told us about that you can provide a selling block space, you just like telling only and thinking only in like look ahead block space, yes?
Mm-hmm.
What if I want to buy like gas in the future, like months, weeks, or months in the future? Is it available?
So currently we have nothing on our platform, but it's a fairly open design space, and there's some pretty straightforward mechanisms to do that. It's easy to create like OTC contracts first to do with it, and I think maybe some validators are already doing this. For us, it's more like how do we kind of standardize these products? So I think we'll roll this out first within kind of like the physical futures market where there is the look ahead, but we'll immediately be looking like further beyond that. It's a fun and interesting space we'd like to explore. Okay. Yeah. Well, there's one more or two more here.
Yeah, I actually had a similar question, but also kind of an answer to his, which is, I mean, the most immediate thing is just to create a swaps market, right?
Yep.
Beyond the look ahead. And
You do like a gas swap market.
yeah, I mean, the swaps market is bigger than the physically settled fixed income market.
Yeah. This is all physically settled at the end of the day, right? We can create an entire derivatives market on top of this, and then we create contracts that go much, much further out.
Yeah, I mean, in fixed income markets, swaps markets is generally bigger. It's certainly more liquid, if you want to get shit done. Yeah, and there's a lot of interest actually in TradFi players already. There's multiple indexes that have been set up.
I was going to say when we, I don't know,
and I know the players like that are doing that. In fact, it reminds me, Coin Fund is one that's particularly interested in this. Kevin, remind me about that. Yeah, but I don't think that there's actually a swaps market trading on it yet. I think they just have an index, and like you guys should run with that.
Well, when I put this article out earlier about the vol, the straddle, it kind of went around some of the option trading communities, and that was it was just an exploration, thought exercise on my side. But all of a sudden, we had these vol traders who were like, "Hey, this is interesting. How do I enter that market?" And so, the 12-minute vol markets on Deribit, you only see those once a day, and there's not much liquidity. But we'd be keen to just push this curve a little bit further out and just see what happens. Yeah. There's another question in the back there. And this is the guy who's done a lot of research already in this space, so he might just crush me right now.
No. I wasn't going to focus on any of the pricing stuff. I was just, I guess maybe, what do you, in this model of, like Christian mentioned, like normally preconfs are considered as selling a specific transaction, and that's like a signed transaction that you know exactly what it is, and that it's been provided by the person buying the inclusion preconf or execution preconf. Like, it sounds like this market will require a lot of trust in the seller. Or that it would be very hard for solo stakers who, like, let's say, don't have the capital or the trust to get involved in this. Like, so do you see this, like, let's say, a market like this as just like increasing the disparity between the revenue of big staking houses and solo stakers?
Sure. So if one has to post collateral, then the larger players naturally would have an advantage over the smaller ones. There's a couple initiatives. Well, one is basically the eigenlayer approach, where I have my ETH staked and I'm going to restake it and post it as collateral here. that potentially leverages the risk at stake for those solo stakers, but that's a capital efficient mechanism for the solo stakers and smaller guys to participate in this market. Separate to that, I don't know how we'll set it up, but there's been a few conversations about pools. The idea that a lot of these solo stakers are actually not solo and they have a bunch of friends or like a small network where they might effectively pool collateral across all of them at one point in time. And so I think that's a reasonable case, a reasonable possibility to get the smaller guys on board. But I 100% want to figure out how can we do this in a way that doesn't kind of advantage one side versus the other. It really should benefit the entire spectrum of validators.
Cool.
Hi. You told that one of the things that you're most excited about is creating fixed yield markets for validators, right? And also users as well.
Correct.
But is this a strong requirement to have this spot blockspace market for creating such a product? So, for example, we have projects like Pendle right now that also sort of has this fixed yield for Ethereum, right?
Mm-hmm.
And basically, like, is it a strong requirement? Probably we could get there without without having spot blockspace market and buying like whole blocks like month away.
Sure, it's possible. So this is, I see this as like, do you want, as gas is like the fabric of Ethereum itself, can we introduce a fixed rate mechanic right at the fabric itself? Because that's kind of like, an analogy would be like, it's kind of almost like a government debt like instrument, whereas Pendle is a bit more like, I'm a derivative product on top of the broader ecosystem running a marketplace.
Because
so
what I'm concerned about is, for example, upgrades on Ethereum base layer, where like up to the point where devs could be incentivized to fork Ethereum itself to change, for example, gas price limit affecting the price.
100%.
And so
I know what you're
basically,
getting at.
same as happens with like so Silicon Valley Bank, right?
Yeah.
So
Yeah.
it could happen.
Yeah, so I'd say to your point, protocol upgrades at the base layer itself, right?
Yeah.
I don't know. The whole point was that, where are we going? And can we kind of put like fixed income, fixed rate instruments like somewhere on the radar? I think as a community, I think that's really my focal point here, right? Sam's he's like the TradFi guy, the big TradFi guy in the room.
Look, I mean, I've thought about this extensively, and Justin was just here, but I mean, the researchers, we've been trying to get issuance down for a long time. That's something we're pushing for, is to lower issuance, and so, as a global macro trader, I bet on what the Federal Reserve's going to do every day, right? In fact, most people in this room, if you've taken out a mortgage, you're like, yeah, is the Fed going to lower rates? Should I wait? Whatever. So it's not a whole lot different, frankly, in a lot of ways. You're making that same kind of decision on what policymakers, or in this case, what a community is going to do. So it is an additional variable that maybe crypto people aren't used to thinking about or interacting with, but it's just it's every day in the real world. But longer term, and again, I would defer maybe to Justin or somebody else. I mean, I think that we're trying to work towards a final kind of fix. I think Justin actually gave this presentation where it's like accelerating ossification, right? So I do think that we're working on kind of an in-game staking design and issuance curve, where longer term, I don't think that betting on the developers or the protocol changing its issuance or monetary policy is going to be a factor, but it could be in the near term, and I don't think that's totally crazy because we do it in the real world every day.
I think I guess maybe a tangent to that, coming back to the earlier point, is that the volatility of gas just permeates through the entire ecosystem. And it's like, how do we set up a framework to just basically reduce the volatility of that for like as much as possible? Because once we can reduce that volatility and increase the certainty, then basically the ecosystem can thrive even much more, right? We know that when there's certainty, like markets rally, right? And so that's the point here. Yeah. Okay, I think we leave it there. Thank you, everyone. If anyone has questions, feel free to grab me on the side.